Good day, investors. In this video, we're looking at Charter Communications, ticker CHTR, and why the current valuation is starting to look pretty interesting. The stock is down roughly 57% over the past year and more than 80% over the past 5 years. Market cap is now just under $18 billion. At these levels, the market is pricing in a lot of pessimism about broadband competition, video cord cutting, and slowing growth. The question is the downside already baked in, and is there meaningful upside if the company can stabilize and start improving from here? That's exactly what we're going to unpack. We'll go through the latest quarterly numbers, look at the analyst price targets, check out the stock price setup, and then I'll share why I like the upside potential at these levels. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. Now, if we start with the second quarter overview, revenue came in at $13.5 billion, down 1.7% year over year. Adjusted EBITDA was $5.4 billion, declining 4.3%. And capital expenditures stayed essentially flat at $2.9 billion. So overall, modest pressure on both the top line and EBITDA, while they kept spending under control. Now, looking at the customer metrics, this is where the pressure remains most visible, and also where we can see the clearest bright spot in the business. Starting with total customer relationships. Charter ended the quarter with 31.5 million customers, down 1.7% year over year. If you look at the net adds chart on the left, you can see the losses have actually been accelerating. They lost 100,000 in the second quarter of last year, then the losses grew to 127,000, 163,000, and now 184,000 in the most recent quarter. So the trend on total customers is still moving in the wrong direction. Internet, which is the core of the business, tells a similar story. They finished with 29.4 million internet customers, also down 1.7%. Net losses came in at 172,000 for the quarter. Broadband competition from fiber and fixed wireless continues to put pressure on the subscriber base, and we haven't seen a clear stabilization yet. However, video was relatively better. They ended with 12.5 million video customers, only down about 0.8% year over year, with a small net loss of 21,000 in the quarter. The video product has been more stable recently, helped by the improved streaming value they're bundling in. But the real positive here is mobile. Spectrum Mobile continues to be a genuine growth engine. They now have 12.5 million mobile lines. That's up 16% compared to a year ago. In the second quarter alone, they added 406,000 net new lines. You can see from the chart that while the net adds have moderated a bit from the peak levels of 2025, they're still adding at a very healthy pace. This is important for a couple of reasons. First, mobile is growing fast while the rest of the customer base is shrinking. Second, a large percentage of Spectrum Mobile data is offloaded onto Charter's own network, which keeps the cost of delivering that service much lower than a traditional wireless carrier. Now let's take a closer look at capital investment and the longer-term spending outlook for Charter. In the second quarter, total capital expenditures came in at $2.9 billion, essentially flat compared to last year. Looking at the breakdown, core CapEx was $1.7 billion. Line extensions were $0.7 billion, and network evolution spending was $0.5 billion. On a trailing 12-month basis, capital expenditures have risen to $12.1 billion. You can see that network evolution and core spending have both increased as Charter continues to invest in the network and rural expansion. On the right side of the slide, leverage remains elevated. Total debt is around $93.8 billion, with leverage sitting at approximately 4.2 times on a pro forma basis. They did repurchase $1.2 billion in principal amount of notes during the quarter for about $1 billion in cash, showing they're still actively managing the balance sheet. Moving to the multi-year outlook, this is the more important part of the story. Management's current guidance for 2026 remains unchanged at roughly $11.4 billion in total capital expenditures. What stands out is the expected decline after this year. Charter is projecting capital spending to step down to around $9.5 billion in 2027, and then further down into the $7.5 to $8 billion range in both 2028 and 2029. That reduction in spending is significant. Lower capital intensity over the next few years is one of the biggest potential drivers of free cash flow expansion, assuming the company can eventually stabilize the customer trends. Now let's look at free cash flow, which is one of the more important parts of the longer-term story. In the second quarter, Charter generated $969 million in free cash flow, slightly below the $1.05 billion they produced in the same quarter last year. On a trailing 12-month basis, free cash flow sits at about $4.7 billion. You can also see they continued to repurchase shares, buying back 4 million shares and units during the quarter for roughly $800 million. Since 2016, they've retired a very large portion of the share count. Looking ahead, the more interesting slide is the free cash flow growth illustration. Management shows that current trailing free cash flow is around $4.7 billion. If they successfully bring capital expenditures down as planned, that alone could add roughly $4.4 billion of free cash flow. Combined with potential future EBITDA growth and continued share count reduction, they illustrate a scenario where free cash flow could approach $9.1 billion. On a per-share basis, that would represent a significant increase from current levels. So while free cash flow is still under some near-term pressure, the longer-term setup is much more constructive if they can execute on the lower capital spending plan and eventually stabilize the business. So after looking at the earnings results, let's take a look at the price targets for the stock. According to stock analysis data, the consensus of about 21 analysts currently has an average price target of $187.35 for Charter. That's roughly 42% upside from the current price, around $132. The range of estimates is quite wide. The low target sits at $101, which would represent about 23% downside. The median target is around $150, and the high target goes all the way up to $380, nearly triple the current share price. The overall consensus rating is hold. So the street is not overly bullish right now, but the average target still implies meaningful upside if the company can stabilize operations. The market is clearly pricing in continued pressure on the broadband business. The key question is whether Charter can eventually slow the customer losses and start delivering on the free cash flow expansion we just talked about. Even reaching the average price target would represent a solid move from these levels, while the high end of the range shows how much upside some analysts see if the turnaround plays out more positively. So after looking at the price targets, let's take a closer look at the stock's recent performance. According to stock analysis data, Charter is currently trading at $131.61. Over the past 6 months, the stock is down roughly 32%. Looking at the chart, you can see it rallied earlier in the year and peaked near the mid-240s in April, before selling off sharply through May. Since then, it has been trading in a lower range, mostly between the mid-120s and mid-140s, and is now sitting closer to the bottom of that range. The 52-week range is very wide, from a low of $111.55 all the way up to $309.40. That means the stock is currently trading much closer to its 52-week lows than its highs. At a market cap of about $17.7 billion, Charter is significantly smaller than it was just a couple of years ago. The valuation also reflects the heavy decline, with a trailing P/E ratio of 3.4 and a forward P/E of around 3.1. These are very low multiples and show just how much pessimism is currently priced into the stock. Overall, the chart shows a stock that has been under sustained pressure for most of the past year. The recent bounce after earnings is a positive short-term development, but the longer-term trend remains firmly lower until we start seeing clearer signs of stabilization in the business. So to wrap everything up, Charter is clearly still facing real pressure on the broadband side, and the customer losses haven't stabilized yet. Mobile continues to be a bright spot, and the company is keeping costs and capital spending under control. What makes the stock interesting at these levels is the valuation. After a multi-year decline, Charter is trading at a depressed multiple with a market cap under $18 billion. The average analyst price target still implies over 40% upside, and the longer-term free cash flow setup looks constructive if they can successfully lower capital expenditures and eventually slow the subscriber losses. This is not a risk-free situation. Competition remains intense, and the turnaround could take time. But at current prices, a lot of the bad news appears to already be reflected in the stock. If Charter can show even modest improvement from here, the upside potential looks meaningful. That's why I find the risk-reward starting to look more attractive at these levels. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching, and happy investing.